Right, JPMorgan Chase, new series. Let's kick it off.
The sitting president sued the largest bank in the country for $5 billion in January 2026, alleging it closed his accounts for political reasons. That same month, the Consumer Protection Bureau dropped its own lawsuit over $870 million in payment fraud losses. In March 2024, regulators fined the bank $348 million for failing to monitor billions of trading instances across 30 venues for nearly a decade. In 2023, it paid $365 million in settlements over a relationship with a convicted individual it maintained, despite internal documents showing it knew. The securities regulator fined it $18 million for using agreements that stopped clients from reporting concerns to the regulator. $4.4 trillion in assets, 60 million households. The checking fee went up 25%. The largest bank in the country, the most fined bank in the country. The bank as it exists today is the product of over a century of mergers. The original House of Morgan financed American industry. Chase Manhattan descended from a bank founded in 1799. The two merged in 2000. The acquisition of another bank in 2004 brought in the chief executive who has now held the position for over 20 years, making him one of the longest-serving leaders of any major bank in history. In 2008, when the financial system collapsed, the government arranged for this bank to acquire a failing investment bank for $2 a share. Months later, it absorbed the largest bank failure in American history at the time. Both acquisitions were government-facilitated. The bank entered the crisis large. It emerged larger. Total assets were roughly $2.2 trillion in 2009. By 2025, they had doubled to $4.4 trillion. The bank that was too big to fail did not shrink. It doubled. In May 2023, it absorbed another failing bank, adding $173 billion in loans and $92 billion in deposits. 3 crisis acquisitions across 15 years. Each one made the bank bigger. The systemic importance designation means its failure would threaten global financial stability, which means enhanced capital requirements, but also an implicit guarantee that the government would intervene before letting it collapse. The stability is real. The question is what that stability costs the people who bank there. But the enforcement record tells you something the marketing never will. In 2020, the Department of Justice filed a criminal deferred prosecution agreement. $920 million total. The bank's traders had manipulated precious metals and treasury markets through spoofing, placing orders they intended to cancel to move prices. The bank agreed the facts in the criminal information were true and accurate. That is a corporate admission that market manipulation occurred. The agreement ran 3 years and was dismissed in 2024 after the bank satisfied its conditions. In 2023, the bank paid $290 million to victims and $75 million to a territory government. Internal documents described in court filings showed JPMorgan Chase decision-makers were aware of the convicted individual's status and allegations while retaining him as a client. The relationship continued until 2013. The bank called the individual monstrous and acknowledged the relationship was a mistake. It did not admit legal liability for what happened. In January 2024, the securities regulator found the bank had been using client agreements that required people to confirm they had not reported concerns to the regulator before the agreement would be executed. Hundreds of advisory clients were affected. $18 million fine. A financial institution using legal contracts to stop its own customers from talking to regulators. 2 months later, in March 2024, the banking regulator and the central bank fined it $348 million combined for failing to monitor trading activity across 30 global venues for nearly a decade. Billions of trading instances not properly surveilled for market misconduct from 2014 to 2023. The same category of monitoring failure that the $6.2 billion trading loss in 2012 had already exposed. But what happens to ordinary account holders tells a different story from the institutional enforcement record. A client deposited a check involving a roommate. The bank flagged it for fraud. Verification required both phone numbers to be confirmed through traditional carrier records. One roommate used a mobile virtual network operator. The bank's system could not verify it, even when the roommate appeared in person with identification. Over 1,000 frozen for more than a month. Tens of millions of Americans use these carriers. The verification system excludes them. A client deposited $20,000 on the 27th of December 2024. Over a week later, the funds had not been released. A separate client had their account closed after unauthorized merchant charges. The bank promised to mail a check with the remaining balance. After more than 10 business days, no check arrived. Another client attempted to transfer $800 to a brokerage during a margin call. The bank blocked it twice under account protection. The market moved against the position during the delay. The Consumer Protection Bureau sued the bank in December 2024, alleging that across 3 major banks, customers lost over $870 million through the peer-to-peer payment system since 2017. The reimbursement rate in 2023 was roughly 12%. 88% of fraud victims received nothing. The lawsuit was dismissed in March 2025 under new leadership before any court order requiring change was entered. No reimbursement mandate ever took effect. In August 2025, the standard checking fee went from $12 to $15 a month, a 25% increase affecting customers who do not maintain qualifying deposits or minimum balances. The bank settled a class action over reordering debit transactions to maximize overdraft fees, $110 million. The current overdraft policy is improved, but the pattern of optimizing fee extraction from the customers least able to absorb it is documented across decades. But the products that work well for the right customer are genuine. JPMorgan Chase is the right bank for a specific customer. If you travel regularly, the credit card ecosystem is the strongest integrated rewards program among the major banks. If you maintain $150,000 or more, the private tier eliminates most fees and provides genuine, dedicated service. If you need 5,000 branches and 14,000 machines across the country, no competitor matches the physical coverage. The digital application is the best of the 4 largest banks. The overdraft buffer at 50 represents a meaningful improvement from the era when the bank reordered transactions to maximize fees. But the regulators fined JPMorgan Chase $348 million for a decade of failing to monitor trading activity across 30 venues. The securities regulator found it was using agreements to prevent clients from reporting to the regulator. It paid $365 million in settlements over a relationship it maintained, despite knowing what it knew. It admitted the facts of market manipulation were true in a criminal deferred prosecution agreement worth $920 million. The consumer protection lawsuit over $870 million in payment fraud was dropped before any reimbursement mandate took effect. 88% of fraud victims received nothing. The checking fee increased 25%. An account was frozen for over a month because a verification system could not process a mobile carrier used by tens of millions. Too big to fail does not mean too careful to fail you individually. Know the fee waiver conditions. Know the payment fraud reimbursement policy in writing. Keep an account at a separate institution. The largest bank in the country is also the most fined bank in the country. Both things have been true for a very long time. The stability is real. The fees are real. The enforcement record is public. Decide which of those matters most to you before you open The account.
Every choice is a trade-off. At least now you know what you're trading.